Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. This week we'll learn from Warren Buffett, Howard Marks, and Seth Klarman about deep value investing or buying a dollar for 60 cents. In this video I'll cover two main topics. Number 1, deep value investing. Number 2, thoughts by Warren Buffett, Howard Marks, and Seth Klarman on deep value investing. There's a strong case to be made that deep value stocks offer some of the best long-term returns in the market. We must first define value investing before we can discuss deep value. Buying a stock that is selling for less than what it is fundamentally worth is what value investing is all about. But first you must determine the value of the company, which is where the difficulty is. A business can be valued in a variety of ways. Some look at quantifiable metrics like the book value or price to earnings, while others, like Benjamin Graham, value companies solely by their hard assets. In the past, value investing has consistently outperformed the market. So value investing is good, but what if we could boost our returns by purchasing the market's most undervalued and unloved company? This is where deep value investing comes into play. Let's first figure out what deep value investing is. Number 1, what is deep value investing? The process of buying stocks or bonds for a fraction of their market value is known as deep value investing. A large margin of safety and a conservative valuation methodology are both required. In some cases, the valuation methodology is a large margin of safety in and of itself. Deep value investing differs from regular value investing in that it focuses on the absolute cheapest stocks in a universe in terms of value. Targets are frequently priced as if they are about to go bankrupt. However, in each case, the market has become so pessimistic about the company that the prices become irrationally low, well below any semblance of reality. The majority of companies go on to have good futures, indicating that the value methodology is overly conservative. Deep value investors make money by sifting through the market's noise and pessimism and find stocks that have been mispriced by far more than the situation warrants. There's also a perception of increased risk, which, as we'll see, can be deceiving. As previously stated, deep value can be broken down into various strategies. The following are some of the more well-known deep value investing strategies. The acquirer's multiple. The formula is as follows: EV divided by EBITDA, where EV, enterprise value, equals market cap plus debt minus cash. The acquirer's multiple is a valuation strategy devised by Tobias Carlyle. Tobias Carlyle is the founder and managing director of Acquirers Funds. He serves as portfolio manager of the firm's deep value strategy. Tobias is also the author of the Acquirer's Multiple. The valuation method is justified by the fact that it provides a more complete picture of the true cost of acquiring a business. This is due to the fact that EV includes data such as debt. The debt load is a major consideration for a company looking to acquire another company. This can help investors avoid value traps by converting a company that is undervalued on a book value basis to overvalued on an enterprise value basis. When you combine enterprise value with an attractive EBITDA, or earnings before interest, taxes, depreciation, and amortization yield, you can come up with a list of companies that would make a good takeover target, with the investor profiting handsomely. However, Warren Buffett and Charlie Munger, as well as other major value investors, frequently criticize the strategy since they call it earnings before all expenses, which is obviously removed from real business reality. Negative enterprise value. Negative enterprise value is similar to EV in that it uses it to find deep value picks, but it focuses on enterprise value That is a negative number. This occurs when a company's cash balance exceeds the sum of its debts and the market capitalization. In these cases, an acquirer would be effectively compensated for taking over a business. Deep value investors will typically look for a high-quality company whose EV has gone negative due to temporary circumstances, such as a bear market. Because these businesses are essentially trading below the value of their cash, they have a good chance of reverting back to a normal stock price. They can generate high returns. Net nets. Net nets are stocks that trade at a discount to their net current asset value, which is our personal favorite, and Buffett's as well. Since its inception decades ago, this strategy, created by the grandfather of value investing, Benjamin Graham, has continued to outperform the market. Net current asset value, or NCAV, is calculated as follows. Net current asset value, or NCAV, equals current assets minus total liabilities minus preferred shares. The metric provides an investor with an extremely conservative business valuation by excluding all non-liquid assets. In essence, Graham believed that purchasing companies at a discount to their NCAV was equivalent to purchasing a company that could liquidate itself, pay off all of its debts, and still have cash to pay shareholders. When we compare the returns of deep value strategies, the strategy also provides some of the best returns available on the market. Now let's look at the second part of the video and discuss the money managers like Warren Buffett, Seth Klarman, and Howard Marks, and get their thoughts on deep value investing. Number 2, thoughts by Warren Buffett, Howard Marks, and Seth Klarman on deep value investing. Warren Buffett. No deep value article is complete without perhaps the most famous value investor alive today, and the man who made the term cigar butts famous. While today Buffett is the modern value camp believing in great companies at a fair price, it wasn't always like this. During Buffett's earliest years under Graham's tutelage and under his own partnership, he sought out the cheapest and most beaten down stocks that he could find, fair companies at a great price, as he put it. A cigar butt found on the street that has only one puff left in it may not offer much of a smoke, but the bargain purchase will make that puff all the profit. Buffett, 1989, Berkshire Hathaway letter. These were the classic net nets we spoke about earlier. Buffett would find companies that were trading so cheaply that the upside was immense. Meanwhile, most of these companies had a strong balance sheet that would allow it to survive its temporary issue. There is no doubt that Buffett's record before his partnership days is amazing, averaging around 50% a year for a decade. The big question is, if Buffett was so successful with deep value investing, why did he stop? I'll let the Oracle of Omaha explain. I was investing peanuts then. It's a huge structural advantage not to have a lot of money. I think I could make you 50% a year on 1 million. No, I know I could. I guarantee that. Buffett is suffering from his own success, and his large amount of managed capital doesn't allow him to invest in the normally small companies where one finds deep value opportunities. However, not all large fund managers have given up on deep value investing. Some of the most famous managers continue to beat the market over the long term by sticking to deep value principles and investing in securities that they see are extremely cheap relative to value. This shows Warren Buffett's partnership versus the Dow. Howard Marks. Howard Marks, a deep value investor who even Warren Buffett listens to, got his start investing in distressed debt, or bonds of companies that were being priced for bankruptcy, demonstrating just how broad the scope of deep value investing can be. As the CEO of Oaktree Capital Management, a hedge fund with a $124 billion portfolio, he is proof of the fact that deep value investing is not limited by portfolio size. Marks began expanding his horizons as his fund grew, focusing on deep value equities such as special situations. Despite managing one of the largest pools of capital in the industry, Howard Marks's deep value philosophy has clearly paid off, as he has produced an average annual performance of 23% over 25 years. According to Warren Buffett, when I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something, and that goes double for his book. When Marks speaks, the investment world listens. Howard Marks has written a number of must-read books on investing, including the most well-received, Mastering the Market Cycle, Getting the Odds on Your Side. Seth Klarman. Seth Klarman literally wrote the book on margin of safety. It is no surprise that this hedge fund manager is a huge fan of Buffett and has maintained one of the best long-term returns for a value investing fund. Klarman differs from many other value investors in that he puts risk above all else and believes that a large margin of safety is what allows him to keep investing in deep value strategies. The deep value strategies Klarman has used are varied and depend on the opportunities present. He has invested in bankruptcies looking to profit from liquidation, similar to Benjamin Graham's philosophy, as well as distressed debt, spin-offs, and other more classical deep value strategies of investing in the most undervalued stocks in the index. The common thread between all of these strategies is risk management. Klarman's fund, the Baupost Group, has been known to regularly have between 25 to 50% of its portfolio sitting in cash. This isn't a hard rule, though, as during the financial crisis, Klarman was famed for investing $100 million a day during specific periods. Klarman's focus on risk has served him and his investors well, as he managed a near 20% annual return over 25 years with only one down year, all while a significant portion of his portfolio was sitting in cash. Here is his fund's performance compared to the S&P 500. Now that we've covered a few of the deep value strategies that everyday investors can start using right now, as well as some of the big names who support them and have built entire careers around them, we are unfortunately not all at the same caliber as Buffett, Klarman, or Mark. They may have access to opportunities that we don't, or are, let's face it, just plain smarter than us. But do you think that we can emulate the same results using these strategies? Let me know in the comments below if you think I missed any deep value investing strategies. Thank you so much for watching, and if you like this video, please share it with your friends and like the video. It'll really help this channel a lot. Leave your comments in the section down below and let me know what your thoughts on this video are and what I should cover next.